Hello and welcome to another video. Banks are something that we all use every day. We have bank accounts, we need to pay money, we need to receive money, some of us even have loans. But not all of us truly understand exactly how banks make their money, why banks take our money, why banks lend money, and ultimately, are banks a safe place to keep all of our money? So let's get going with the video and find out how banks work. Before we get started with the video, please make sure you hit that like button and smash that subscribe button so you don't miss out on any further videos. So banks. Banks are a fundamental part of life. Most adults have a bank account. Most adults use banks to pay friends, family, pay for services. We have debit cards, credit cards, some even have loans. Banks take our money and use our money in different ways. But ultimately, how do they work? How do they make their money? And is our money safe when we have it with a bank? Well, banks are a fundamental part of the financial world. Banks really keep the economy moving. Banks are essential in the world of finance and they provide a great service. They take our money, they keep it safe so we can use it whenever we need. However, like any business, they have one aim, and that is to make money. Sounds simple because they're a bank and they revolve around money, but ultimately they make money. And in this video, we're going to discuss how banks take our money and then lend it out, and the difference between the rate that they pay to us for holding our money and the rate which they earn from the money that they lend out is how they make money. So really how banks work is a two-step process. The first step process is we deposit our money into a bank account. This is because banks are safe and we know that the money will be there when we withdraw it. The next step is what banks then do with our money. Banks take our money, pool it together with other people's money, and then lend it out to people who need that money in the form of mortgages, credit cards, car loans, personal loans. The difference between the interest that the bank charges on a loan that it gives to the amount of interest that it gives someone when they give a deposit is how banks money. An example of this is if I take £100 of my money and give it to a bank, i.e. I put it into a bank account, I will have a balance in my bank account saying that I have £100. This £100 might earn an interest rate of say 1%. This means that for giving the bank my money, I will earn 1% per year on that money. So in a year's time, I will earn £1. The bank then will gather up that £100 with possibly thousands of other people who have deposited their money. And then they will loan that money out in the form of, say, a mortgage for someone to buy their house. And what they'll do on that mortgage is they'll charge far more than that 1% in which they're paying me. They'll probably charge 3, maybe 4%. So therefore, on that mortgage that they're paying out, they'll be charging 4% of the balance, which means they'll get 4% in, and they'll pay me out 1%. The difference between those, that 3%, is what the bank keeps and how the bank makes their own profit. And this is ultimately how banks keep the economy moving. By people depositing money into the bank and banks lending that money, it means that people who have borrowed the money from the bank can then spend it on other goods and services. In an example where someone's buying a house, I've deposited the money into the bank. The bank has then used that money to lend on a mortgage for someone to buy a house. Is then using the money that they've got from the sale of that house to buy another house. And that's a long chain and it just keeps going and going and going. And you can see by one bank lending encourages other banks to lend and other people to spend, thereby keeping the economy moving. As you can see that banks lending money keeps the economy moving. And should banks stop lending money, it would be catastrophic and it would stop the economy. Just to put this into perspective, £500 billion is moved between bank accounts every single day. That's over £5 million every single second. And it just shows how important banks are. And should banks stop working, it could be catastrophic. One key principle that we have to understand when we put money into a bank is that really we're not just depositing money. In a way, it's similar to investing in a bond, where we are lending the bank money for a certain amount of interest. However, often we have the opportunity to withdraw it whenever we want. In the same way in which bonds, you lend money to a company or a country, when you deposit money into a bank, in an essence, you're depositing it and lending it to the bank so that they can use it to lend to other people and make money. Now, you're probably looking at me and saying, well, sure, if banks take my money and lend it out, how come I can then go to the bank, go to the ATM, go to the counter and take all my money out? Well, the reason for that is because this process of people putting money into the bank and then people taking it out is happening all the time. Whilst you might be in the bank withdrawing your money, the person next to you might be depositing their cash. And that cash is money that A, you can take, and B, the bank can then use to lend to someone else. The second reason why this can happen is law. Banks are required by law to hold a certain amount of money in cash. They can't just take all the money from people and then just lend it out, leaving no money, because that could be terrible. What they have to do is they have to keep a certain percentage of money in cash should people like you and I go to the bank and want to withdraw a small amount to pay for our everyday expenses. Banks running out of money is a serious problem. However, it is extremely rare. When banks run out of money, it's normally because people have rushed to withdraw all their money at the same time. Banks, as I said earlier, by law have to keep a small amount of money as reserves, which really just keeps them afloat for everyday withdrawals. However, if something exceptional happens and lots of people at the same time want to withdraw their money, the bank runs out of those reserves and effectively goes bankrupt. This is exceptionally rare given regulation. However, this has happened multiple times over history. It's happened in the 17th century during the tulip mania, and even back in 2008 in the Great Financial Crisis, where a bank in the UK called Northern Rock had a run on its bank and went bankrupt. But fortunately for most people, runs on banks are incredibly rare, mainly because there's legislation and regulation to protect people's money when they're held in banks. A good example of that is in the UK, a deposit in a bank is protected up to £85,000, which means that should there be a run on a bank, £85,000 of your money is protected by the government. So you don't have to worry about losing all that money. In this video, I really wanted to highlight how banks make their money by you depositing their money and them lending it out. I really want you to think about that process next time you put your money into a bank account. When you think, am I going to use this money in the short term, or am I putting it into this savings account and held for a long term? Most people that I know, and I'm sure other people know, say put your money into a bank account, save it, not necessarily invest it where you could lose your money. However, when you really think about how banks make their money, you have to think that if banks are comfortable taking your money and paying you a small amount of interest, and then using that money to charge someone else a higher amount of interest, why aren't we doing it? Why aren't you taking your money that you have in a bank account and investing it into assets that make money? If putting money in bank accounts was a secret to wealth, then everyone would be millionaires or billionaires, but they're not. Billionaires of the world invest in something. This could be a business, this could be stocks, this could be bonds, this could be real estate. But they physically hold equity slices of the financial world. They don't just store money into bank accounts, because if they did, all that would happen is every single bank or banker would just put money into another bank account and everyone would just be getting rich. However, that's not how the world works. Let me know in the comment section below if you use bank accounts as your main storage of wealth, and maybe you're looking now to invest it into the stock market, into bond market or real estate. So to wrap up, banks are an essential part of our daily lives. Without them, we wouldn't have a safe store of money, we wouldn't be able to get loans, and the whole economy would grind to a halt. However, what I really want everyone to take away from this video is to understand that whilst they're great for many purposes, like holding our money for a short term so we can easily access it, you have to understand that they are using our money to make money. And if we have huge sums of money just sitting there in a bank account, it could be better used elsewhere by investing in other assets that will make us money. So remember, the next time someone comes to you and moans about how low the interest rate is on bank accounts, just tell them you can't get rich off bank accounts, and stop moaning and invest that money elsewhere, because it will make you more money and then they'll stop moaning. So if you've enjoyed this video, please make sure you like it and hit that subscribe video, and I'll see you next time.